Today, we're talking about a big question in investing. Should we spend time in the market or try to time it just right? This is a debate that has been going on for decades, and there are pros and cons to both strategies. Let's explore and make sense of timing the market versus timing the market. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. In the investing world, people often say it's better to stay in the market for the long haul rather than just trying to guess the best times to jump in and out. Why? Well, predicting which stocks will do well over time is tricky. Many factors affect stock prices, such as earnings, news, trends, competition, and consumer behavior. Emotions, the complexity of markets, and the practical challenges of investing make it tough for most people to time the market successfully. Common arguments against timing the market. Let's break down why timing the market might not be as great as it sounds. Number 1. Erosion of gains. Imagine missing just one crucial prediction. It could wipe out a big chunk of your earnings, like what happened during the Great Recession. From October 2007 to March 2009, the S&P 500 lost about 50% of its value. If you sold your stocks at the bottom, you would have missed the recovery that followed, which saw the index more than quadruple by 2021. Number 2. Emotional pitfalls. Emotions can lead us astray, especially during wild market swings like the dot-com boom. Tech stocks were booming in the late 1990s, and many investors got swept up in the hype, buying stocks at inflated prices. But the bubble burst in 2000, and some tech stocks lost about 90% of their own value. Many investors panicked and sold their stocks at a loss, while others held on to them for too long, hoping for a rebound that never came. Number 3. Missed dividend income. Dividends are a steady income stream, making up around 40% of total returns since 1930. Missing out on these during times you're out of the market can hurt your overall gains. For example, if you invested $10,000 in the S&P 500 index in 1980 and reinvested all the dividends, you would have had about $1.2 million by 2020. But if you missed the 10 best days in each decade, you would only have about $300,000. Number 4. Investing costs. Then there are the practical costs of trading, like bid-ask spreads and capital gains taxes. Bid-ask spreads are the difference between the price you can buy and sell a stock at any given time. They may seem small, but they add up, especially if you're dealing with less popular stocks that have lower liquidity. Capital gains taxes are the taxes you pay on the profits you make from selling your stocks. These may vary depending on your income level and how long you hold the stocks. Long-term gains from stocks held for more than a year often get better tax rates than short-term gains from stocks held for less than a year. So far, we've talked about some of the common arguments against timing the market. But there are also 2 less discussed reasons why it might not be worth it. Avoiding market downturns is tricky. Predicting these is like navigating a maze in the dark. You never know when the next crash will happen, what will trigger it, or how long it will last. Even if you manage to get out before the market falls, you still have to decide when to get back in. And that's not easy either. You might miss the bottom and lose out on the rebound, or you might get back in too soon and suffer another loss. The less visible cost of playing the market timing game is that potential gains might not outweigh the costs. The gap between potential gains and costs shrinks fast with every missed prediction. According to a study by Morningstar, the average investor who tried to time the market from 2004 to 2019 earned only 4.3% per year, compared to 8.9% for the S&P 500 index. That's a huge difference over 15 years, and that's assuming you only missed one prediction per year. If you missed more, the gap would even be bigger. Analysis with hypothetical investor. Let's imagine a scenario comparing a market timer and a steady buy and hold investor from 1980 to 2022. Meet Jim, the market timer, who can predict market bottoms. He buys stocks at the lowest point of each year and sells them at the highest point of the next year. Meet Jane, the buy and hold investor who invests $10,000 in the S&P 500 index at the start of 1980 and reinvests all the dividends. Who do you think will end up with more money by 2022? You might think Jim would win by a landslide, but you'd be wrong. Even with his perfect foresight, Jim's gains aren't as huge as you'd think. He would have turned his $10,000 into about $2.7 million by 2022, which is impressive. But Jane would have done even better. She would have turned her $10,000 into about $3.2 million by 2022, beating Jim by about $500,000. Now, how is this possible? Well, Jim's strategy has two major drawbacks. First, he has to pay capital gain taxes on his profits every year, which reduces his net returns. Second, he misses out on the dividends that Jane collects and reinvests, which compound every time. These two factors make a big difference in the long run, and they outweigh the benefits of Jim's market timing. This shows that most gains from market timing come from selling high and buying low, avoiding major market crashes. But these are rare events, and they are hard to predict. Most of the time, the market goes up and staying invested pays off. To wrap it up, successfully timing the market is like a tricky dance. While it could theoretically bring more money, the real-world costs, like bid-ask spreads, taxes, and the complexity of perfectly timed trades, often outweigh the potential gains. Plus, you have to deal with the stress and uncertainty of constantly watching the market and making decisions. On the other hand, staying in the market for the long term is like a simple walk. It may not be as exciting, but it's more reliable, less risky, and less costly. Plus, you can enjoy the peace of mind of knowing that your money is working for you. I'm curious to hear your thoughts. Do you find market timing to be a worthwhile strategy, or do you prefer the stability of long-term investing? If you found this helpful, give us a thumbs up, subscribe, and share this video. Your support helps us break down the complexities of investing. Thanks for hanging out with us today. Until next time, happy investing.